Hey, it is Lon Welsh at Ironton Capital. Thank you for joining me today. We're going to talk about the 8 factors of due diligence and better understanding risk before you sign on the bottom line. Grab a pen and paper. We're going to go through these in a lot of detail, pull back the curtain, and show you how to make your investing a whole lot easier. So I'm going to show you a lot of actual case studies with some hard data today. None of this should be really interpreted as a claim of income, implied or otherwise. So just a quick note from the attorney, there's some confidential information in here. You're very welcome to share this with your financial team, but please don't distribute it beyond that. Any form of investment involves risk, so you'll want to talk to your financial team to understand what types of risks are involved with this sort of investment and if it's a good match for your situation or not. Nothing in today's discussion should be construed as an offering of an investment opportunity. If you do have interest in investing with us, we would be delighted to share the appropriate legal documents for you and your counsel to review in depth to make sure that you understand every single facet. There's a lot of forward-looking statements. You're going to hear words like will, should, expect, plan, seek, anticipate. These are all based on our best understanding of the market, the research that we've done, the interviews we've conducted with different sponsors, and of course our reliance on a lot of company-sourced information. So you'll want to do your own research on the market to make sure you like what you see. So who is Ironton Capital? So this is the investment committee. There's 3 of us. My name again is Lon Welsh. I spent 8 years working as a strategy consultant at Deloitte and Accenture as a corporate finance before that. And then I've got a couple of decades working in commercial real estate acquisition and development. My cumulative score over the whole couple decades is a little bit above 20% per year. And I ran a large brokerage that I built from scratch, became the largest independent in Colorado with about 750 agents. So certainly learned a lot from watching from the sidelines of all those deals as well. So Brent Geyer is our CEO. He did acquisition and land use with Intrawest and Pulte, and he was a CPA with KPMG at the very beginning. Richard Landry comes to us via Goldman Sachs. He used to run as the chief investment officer at a $2 billion family office, and has had a couple of other large jobs. So the three of us collectively work to make all the decisions of what we invest in. So the fastest and most predictable path to financial security and growth is passive investing. If you can get your investments on autopilot, you're on your way to true freedom. So you can do this in a way that you can have the free time to spend with your family, your hobbies, and your philanthropic interests and not be distracted by micromanaging your investments all the time. So today we want to talk about the 8 factors of due diligence. This comes from the book that I wrote on passive real estate investing, and I wanted to do a webinar just so you could listen to it while you're driving or going for a run. I want you to know some of the questions you should ask, so you can ask them with confidence when you're evaluating an investment, how to better tightly manage the risks that you take on, try to avoid some costly mistakes by having a shorter learning curve, and diversify your investments. Everything really is about diversification. So I hope this will be a really useful dialogue for all of you. You know, most of what you hear on the news about investing is not all that accurate. The frustration as a media executive is that they've got to distill everything down into a 30-second or maybe 1 or 2 minute soundbite. And a lot of the issues through the economy and real estate investing are pretty complex. They don't warrant treatment in the appropriate depth in that short of a discussion. So you just get a shortcut, and it's really easy to draw the wrong conclusion. So I applaud all of you guys for making the time to really invest in yourselves to learn more about what is involved in due diligence and not just take the 30-second answer. A lot of these investing educators don't have any real-world experience versus this is what I've done full-time for a couple decades. And this is a great time when fortunes will be made. As I think Warren Buffett said, when others are afraid to buy, you should, and when others are enthusiastic about buying, you probably should be selling. So are the 8 factors of due diligence appropriate for you? It doesn't really matter if you're an active or a passive investor. If you're trying to make additional investment choices, I hope at least several of the things we talk about today will help you make a better decision the next time that you're making one. If you're a novice investor, then all this will be kind of overwhelming and new information. You're always welcome to set up a one-on-one call with someone on the investor relations team, and we'll answer any questions that you get after you go through this presentation today. And if you think that you see There's good opportunities in today's market. You're absolutely right. There's a lot of really good opportunities right now. But if you're lacking the confidence to move forward, this might help you understand some of the better questions to ask to move ahead with confidence. So my main mission is to help you make these investment decisions quickly and consistently. That's the important word, by shortening your learning curve. So when you leave the heavy lifting to the experts, you're going to immediately notice how much happier you are and how much easier it can be for you to build a legacy. So during our time together today, you're going to have the opportunity to see the world of investing through our experienced viewpoint. You're going to see how our system has changed, and I want to show you how I went from being an active to a passive investor, and you can too. Hopefully that sounds pretty good, huh? So here's the 8 large themes I want to explore with you today: tax implications, alignment of goals, returns, track record, liquidity, due diligence of the sponsor, how you hold title and some of the implications of that, and then finally funding of the investment. So let's drive into each of these. So for tax implications, you want to understand which of these things that come out are going to be deductible for you. So if you're an active investor, things like mortgage interest and taxes and operating expenses will help reduce your taxable income from real estate investments. And similarly, if you're doing a passive investment, we'll do all that accounting for you and just show you the small amount of income that is actually attributed to you. Usually, we'll have a lot of depreciation that we can use to apply against the net operating income, NOI. So in the early years of your investment, you probably won't have much, if any, tax liability. Depreciation, if you're not familiar with it, is just an interest-free loan from the IRS. You're allowed to take additional deductions, which reduce your income in the current year. You do have to give it back when you sell the property down the road. So it's not a gift from the IRS. It's an interest-free loan from the IRS. But when you hear these headlines about these billionaire real estate investors not paying any taxes, usually it's depreciation is the engine that makes that tax management possible. You're going to want to know, for the overall distributions you receive from your fund, what is the expected allocation across ordinary income and capital gains? So for most of you who are listening to this, you're probably a very high income earner, and your marginal tax bracket might be in the 30-35% range. So if you can shift from receiving ordinary income to getting capital gains, which might be closer to a 20% tax bracket, it can really help you out a lot. So make sure that when you're talking to someone about an investment, you understand the tax implications of it, and then consult with your CPA to figure out how that figures into your overall financial plan to make sure that it's an optimal investment. So for us, our short-term income fund is taxed as a REIT, a real estate investment trust. So for most of you, that's going to be at about a 20% tax rate. So even if you're high income and your marginal tax rate on your ordinary income is in the 30s, the short-term income will probably be taxed in the 20% because of the REIT status. And again, check with your CPA. Our long-term fund, which is called the National Diversified Fund, has 2 share classes. One share class gets a slightly higher preferred return, but none of the depreciation losses. So if you are just a W-2 worker with not any other sort of like gains, that might be the right answer for you. Check with your CPA, but generally that's the case. If you're investing in an IRA, you probably don't want any depreciation because you can't use it. On the other hand, if you're currently an active real estate investor and you're going to be selling a rental property, you're tired of working with the tenants, you'll probably have a capital gain at the sale, and you'll have some depreciation recapture. This is when you give the money back to the IRS from that interest-free depreciation loan. The B share class of our long-term fund gets a little lower pref, and it takes all of the depreciation. Check with your CPA, but you should be able to use our depreciation dollar for dollar to offset your capital gains and your depreciation recapture. So it's basically a way to synthetically recreate the tax benefits of a 1031 exchange, and you can still get off the treadmill and not have to be an active landlord anymore. So if any of this is of interest to you, call and set a time to talk with us, and we'll explore this in more detail for the details of your unique situation. We're not tax advisors, but we can certainly try to point you in the right direction. So I'll show you a little bit of a case study here. Here's someone, this is an actual investor with us, that had a condo they used as a rental. The value was, they thought, would be about $315,000 if they sold it. Their debt was about 130. You can see this in the upper right-hand corner. So about 184,000 was the equity in the property. And our estimate that we developed with them was that they thought it would generally appreciate at about 2.5% a year over the next couple of years. So that's around $8,000 or so, and it generated about $8,000 of cash flow. So this particular property in total was generating about a $16,000 return between the appreciation and the cash flow. If you divide that into the 184,000 of equity, that's about a 9% annualized return. And we're going to use this as an example and talk about depreciation write-offs in just a little bit so you can see how this ties to the tax theme. So an analysis I do frequently for our prospective investors when they have an active real estate rental is figure out, first of all, if you do nothing, what wealth appreciation will your family enjoy over the next decade? Because doing nothing and keeping the asset is always a good strategy. There's nothing wrong with that. You just have to deal with the tenants. So there's 184,000 of equity in this rental condo today. And if you take a look at how those gains would multiply over the years, you'd end up with about $430,000 of wealth instead of the 184 you have today a decade from now. And that's compounding interest at about 9% per year. So as Einstein reportedly said, compounding interest is the eighth wonder of the world, and that's very, very true. This is why real estate creates so many millionaires. There's option one. So you may ask, well, what if I sell? What are the tax implications going to be? So what we'd want to do is, if you wanted me to do this analysis for you, I just need to know what you paid for the property, what you think it's worth today, a ballpark of how much you've put into the property over the years for renovation. Maybe there's a new furnace, a new roof, you did a kitchen remodel, and then when did you purchase the property? And from that, I can come up with a pretty good guesstimate. Your CPA, of course, will be to the penny. I can just guesstimate it for you of what your capital gains liability would be. So on this first slide, we're just going to take a look at how much cash will I have after I sell. So I've got this value of the unit, the debt, equity is 184. Perhaps my sales costs with commission and inspections and everything would be 6%. So maybe I net 165. So if I take a look at, if I sold this and I invested it in the stock market, what would happen for me? Well, the answer is I'd start with my 184 of equity. I'd have my 19,000 of transactions cost to back out. And the estimate we came up for this particular investor was about $30,000 of depreciation recapture and capital gains. So the amount that would be available to invest in the stock market would be about $135,000. If you take a look at a stock and bond portfolio over the last 50 or 70 years, on average, it's returned at just over 8% per year. Certainly some volatility. We've seen a lot of volatility in the markets recently, but long-term, the stock and bond markets have done very, very well if you're not in a rush. So the stock and bond market at about 8% is pretty close to the 9% you'd get holding it as a rental. But the problem is you've got the transaction costs and the capital gains that eat at how much you can invest. So the wealth accumulation over a decade for this family is going to be about $295,000. So a little less than the 430 if they just did nothing. However, if you're just sick of dealing with the tenants, and you'd like to have access and liquidity to your capital whenever you want it, stock and bond market's super duper liquid. You can get access to it anytime that you want. So that's always an option. Another option for you is you could put it into our medium-term income fund. So it's going to pay between 11 and 13% depending on how much you have invested with us. Of course, the more you invest, the higher the rate we can pay you. And it's paid out quarterly, and it has liquidity after a year. So not as liquid as the stock market, but since it pays on average about 12%, it's also a lot more lucrative than the stock market. How does this work out? Well, you've got your 184,000 of equity from your rental, just like the other scenarios, same transaction costs, the same capital gains, and you get to invest the same 135. But here, you're growing at 12% per year instead of 8. So you can see that this family is going to wind up with 420,000 of wealth after a 10-year period, as opposed to the stock market, 295, or do nothing, 430. So basically, you could sell, for this particular investor's scenario, the rental property, no longer have the headaches, get a quarterly dividend check, and make almost the same amount of money as you would have had you just kept the property. This is a very common scenario that we see very frequently with our investor base. That's medium term. So the final option is you could do our national diversified fund. So we have two share classes like I talked about. I'm going to take a look at the share class B that gets the depreciation. And I used a conservative estimate of how much depreciation we'd be able to get to you. So what you notice here is that you've got the equity from your old rental and the transaction costs, but here the capital gains bite is only 15,000. In the prior examples, it was 29,000 of depreciation recapture and capital gains. So I've been able to cut the transaction costs of the tax bill in half because of the depreciation benefits that we have from the National Diversified Fund. This is based on the tax code as I'm recording this at the end of May. Now, you might recall when Trump was in office the first time, they had a tax reform package that they passed that greatly accelerated the recognition of depreciation, particularly for real estate investors. So we were able for a period of time to write off a lot more than we can today. The tax bill, as I currently understand it at the end of May, that Congress is working on is going to reenact that acceleration of depreciation. I wouldn't want you to make a decision on investing based on what Congress might or might not do, but we should definitely track that closely. And if the bill does pass in the form that it's currently written, we'd probably be able to wipe out all of your capital gains. So that's something that we'll definitely want to be in close communication with as we see developments out of Washington and of course, collaborate with your CPA to figure out the situation. For today, however, though, I just want to look at the tax code as it is, as it stands. I can cut your tax bill in half. So you can invest 149. Our target return for our long-term fund is between 17 and 20% per year. So I put in the lower number of 17. And you can see that for this family, they would wind up with about 720,000 after a decade, versus if they do nothing, they'd be at 430. This is another very common situation where I see an active investor selling their rental property and they'll put it into the long-term fund and then get this huge amount of gain over time. Younger investors usually do that. The older investors who have retired frequently, they're close to or they have paid off the rental. They'll typically use the income fund because they're relying on the income from their rental to supplement their lifestyle. They just use MTI to do that in the future. So just an example of how the tax handling of your investment would be one of many factors you'd consider in the overall assessment of any given real estate investment or non-real estate investment too. So this page just pulls it all together. What's your estimated wealth in 10 years? So if you just stick with what you've got, 430. If you do the medium-term fund, 420. Do the long-term fund, 720, and the stocks and bonds a little bit less. So the second factor of due diligence I want to talk about is alignment. So the most important thing here is what are the objectives of the investment and how do those match up with your family's long-term objectives? And then what's the risk tolerance? So for us at Ironton, with our income funds, principal preservation is an absolute. We need to get the money back and we're okay to have a lower return in exchange for greater certainty. The difference between our short-term and medium-term income fund really is about liquidity. In our short-term fund, you can get the money out on relatively short notice, and as a result of that, it pays around 8% plus or minus a little bit. The medium-term fund is locked up for a year, and then you have to give a quarter's worth of notice to get the money out. So since the liquidity is not as smooth as the stock market or our short-term fund, it pays 12%. You have to be paid for lack of liquidity. The long-term fund, where we're investing in commercial real estate, once again, our main focus is on principal preservation. So my objective is to invest in projects that are reliably going to hit singles and occasionally a double. I am not chasing home runs and grand slams because there's never a free lunch where you can get an ultra high return without taking a lot of risk as well. If you're not happy with 17%, you're welcome to go invest with somebody else. I'm happy at the level of risk we've got with where we're at. So just make sure you understand what the risks are with the fund and that they work out for what you guys want. Our National Diversified Fund, you're getting a basket, usually somewhere in the range of 30 to 40 different commercial properties of different asset classes like multifamily, industrial, hospitality, sometimes self-storage. And we're also trying to be in at least 10 different states. If you're in Colorado, you've probably seen over the last 3 years, there's been a lot of legislation A lot of new laws that are very anti-landlord, pro-tenant, that make it much more difficult to be in the rental business now than it was, say, 4 years ago. Colorado's become an unattractive state for investing, at least in multifamily, for that reason. We don't want to have all of our eggs in one basket in one geography, because if that happened, let's say we had everything in South Carolina and they copied Colorado, we'd be in the same boat. So we want to spread the risk out as much as we possibly can. With our short-term fund, we're in about 300 different loans, so there's a lot of diversification. With our medium-term fund, it's medical receivables, and we're in tens of thousands of receivables. So if a couple of them break, you're not even going to notice. It's a rounding error. So make sure you understand the risk factors. A common issue that I see with newer investors is they may invest in a syndication where they're helping to raise equity for just one, let's say, renovation of an apartment building. So all of your eggs are in one basket. If that one investment doesn't work as planned, there's no other backstop to bail you out. I want to be in a situation where I've got 30 properties in a fund. I expect problems on one or two. I expect one or two are going to end up doing a lot better than we thought, and most of them are going to come in just about as planned, as a base hit, a single. And on average, the entire fund works out great. This is why people buy mutual funds with hundreds of stocks in them, for that exact same reason. So this is our recent NDF 10, the fund that we're working on right now. We've got 8 investments with 38 properties, and I think it's 11 different states. So returns, you want to know about income, appreciation, what fees you have, and what sort of time sensitive do you have. So I want to talk a little bit about time, because I think this is one that's not appreciated by most newer investors. The amount of time is not as important as the amount of return, but it's definitely in second place for driving the overall results. So on the left bottom, let's pretend we've got a short-term project that we're going to be hopefully investing in for 2 years. We're going to put $100,000 in. 2 years later, I hope to make $145,000, and that works out to a 20% internal rate of return. What if there's a delay with permitting or construction, or it takes longer to sell it at the back end than we thought because maybe there was a recession and just sort of dragged out the sales cycle? And instead of 24 months, it took 30 months, an extra 6 months. Well, you can see that the IRR goes from 20 to 16 by adding just 6 extra months. So the speed at which we can successfully execute the project matters, as well as the amount of gross return that we can generate. Speed also matters on longer lifetime projects, but it's not as sensitive. So to illustrate that, if you look at the target case, this is a 5-year project, and the target, we're putting $100,000 in. We expect to get $250,000 back. That's also a 20% return. You'd have to delay that project by an entire year, not just 6 months, to go from 20% to 16%. So the longer the project, the less sensitive it is to little delays, and the more likely it is we can still deliver the returns that you expect from us as a limited partner. So make sure that you factor this in as you're evaluating different investments, and do ask about that. What are the risk factors? My favorite type of investment is one that's underwritten from a 5-year standpoint, but the realistic business case is that we'll do it in about 3.5. If things go our way, and it is done in 3.5, instead of giving you a 20% return, I'd probably be giving you like a 28 or a 29, and it's just a whole lot of extra return without any incremental risk, and that's always a beautiful thing to happen. So we talked about the different time frames of the different funds and the lack of liquidity. And if you have less liquidity, of course, you have to get paid more, or else it wouldn't be very exciting for you as an investor. The fourth factor on due diligence is track record. So it's really important that you ask a lot of questions about how many projects has this sponsor done before, how many were like this, and it's okay if there's problems. I don't expect every project's going to work. I'm looking for a basket of projects that on average, I've got 1 or 2 that break, 1 or 2 that are really outstanding, and a bunch that are okay. One additional thing is to drill in a little deeper on the exceptional ones. So I want to share an example from Fund 1 that I ran. My best investment by far was a build-to-rent community in Texas, and we anticipated it was going to be something around a 20% IRR to our LPs after all expenses, and we did really, really well. Ended up being in the 50% range to our LPs. And if I trotted that out to you, you'd say, God, these guys are fantastic. But in a lot of ways, that'd be bullshit. And the reason why is we bought this in April of 2020. And if you remember back in time, that's about the time that COVID was launching and the world was at maximum panic in April of 2020. We bought at the best possible time into this project and we were able to negotiate a much better price than we ordinarily would have been able to as a result. And we finished our project ahead of schedule and we sold it in, it's like February or March of 2022. If you look back on when the interest rate started to take off and consumer confidence started to decline, it was in April of 2022. So what this means is I bought at the absolute best moment in time and I sold at the absolute best moment in time. And since I absolutely nailed by accident both of those, instead of having the 20% return that we deserved based on the fundamentals of the project, I got something in the mid 50s for my LPs. You have to look at the very, very high returns with a degree of skepticism and drill into things like timing of the market. So that's my biggest success from Fund 1. I have to tell you about my biggest failure from Fund 1. I bought an office building in an office park, great area in Houston, right before COVID. And we got it for a good price, had some vacancy. We were going to renovate the unleased units, get the building leased up, and sell it. And as you would expect, right before COVID, we paid a normal price for it. And then after COVID, nobody wanted to be in the office. And it was a total loss for us. So also, when you're evaluating the track record, take a look at the factors that might have been out of the control of the sponsor that might have driven an unusually negative result. I hope when you look at our Fund 1 results that you would give me less benefit than I deserve for the 54% return. And I hope that you won't punish us quite as much for the Houston debacle. Overall for Fund 1, we made 8 investments, 1 stunning, 1 total strikeout, a bunch of base hits. We're going to be in the low teens. The fund is going to work out fine. But this is why you want to have 8 and not 1. When you talk to a sponsor, they may not be able to disclose as much as you would hope. Sometimes they will view the composition of their funds as being proprietary and confidential. I don't feel like I have that limitation. I'm willing to share with you everything I've done in the past and the actual results that I've gotten. Some is great, some is not so great. I need for you to know the whole picture for you to go evaluate that. Not everyone will always be able to do that. Some part of the outperformance that we generate is due to the fact that the sponsor is raising $500,000 to $1 million at a time from people like us versus an individual investor might be writing a check for $25,000 or $50,000. So you would expect we'd be able to negotiate better terms writing a better check, and that's almost always the case. I usually have a non-disclosure agreement where I can't disclose like how much better of a deal that we got. I can just tell you that we did better. So if I can tell you, I will. I occasionally will have limitations on things like that. There may be some compliance issues that some people will try to hide behind. At least with what we do in real estate, we don't have that as an issue. But do take the time to dig into the track record of what your sponsor's done before, and you want to see that they've done a complete round trip. By that I mean they thought of the project, executed it, and sold it, and they got the result. And then you can evaluate that and then compare how similar is that project to the one I'm looking at today. This is one worth taking time on, and I feel like a lot of people kind of glossed over this. Here's our track record. So like I was talking about Fund 1, we've realized 5 out of the 8 investments. We're tracking to about a 14%, a little on the low end of what we expected, but given the chaos in the market, I'm not too bad for that. So what I'm really proud of overall, though, is that we're building a legacy for our investors and their families, and we're here for the long haul, so we're hopefully a good match for you. Liquidity, we talked about a little bit earlier. How quickly can you access your funds? So with our debt funds, the short-term income, the medium-term income fund, we talked about that. We talked about how our long-term fund, there's no liquidity for 5 years, and that's why the less liquidity, the more return you should expect to get, or else it's probably just not a very good option for you. So make sure you understand what liquidity options you have, if any, with an investment before you get into it, and make sure you talk to your financial planner to make sure that dovetails in well with all of your financial plans. And if something unexpected, like maybe your spouse got sick, wasn't able to work anymore, would you have enough of reserve funds to live off of without having to do a fire sale of a non-liquid asset, because you're never going to get a good price in a situation like that. Due diligence. So this is something I could talk about for hours. There's six of us. I'm sorry, six of us. There's six of us overall talking to investors, but there's three of us that are on investment committee that all we do is think about investing all day and evaluate the projects and fly out to go see them. So there's many things to think about. The first is to really evaluate the property and the management procedures at the property to make sure it's a good fit for what you want. When I look at a property, a lot of times, I'll give you an example. So in Fund 10, we are making an investment in a portfolio of 4 apartment communities in and around the Kansas City area. And when you build a new community, one of the options you have is you could decide, I'm going to serve the low income segment of the market. I'm going to do a LIHTC deal, low income housing tax credit. So I'd sign a commitment with the local government authorities that I'm going to rent below market to people who are making less than the average income in the area in exchange for a huge basket of tax benefits and subsidies from the government. Usually those LIHTC contracts last for 30 years. So for what we actually invested in Fund 10, the original builder still owned the property. Our hypothesis is that he's pretty old, got sick, probably in a nursing home, no longer able to run the property. Now the spouse is stuck running it, and I'm sure she's also in her 70s or 80s and very unenthusiastic about running this. And the kids apparently don't want any management responsibilities. So they wanted to get rid of it. So we paid a fair price for this LIHTC property based on the low rents currently in place. And it's 29 and a half years into its contract. So we told the government authorities, look, we've enjoyed the ride. We're not going to renew it at the 30-year anniversary, which is coming up in 6 months. Our plan is to renovate the units very lightly because they're in really good shape and raise the rent several $100s up to market, stabilize the asset, and then we're going to sell it. So one of the important things for us from a due diligence standpoint was to validate those LIHTC documents with our attorney to make sure, can we actually get out of this at the end of 30 years? How much notice do we have to give, and what's the proper way to go about doing that? So we follow it to the letter of the law. Then another element was to take a look at, here's the geographic location of these 4 subject properties. If you draw a couple mile radius around each one of them, what other apartment communities are we competing with? And then we had to go visit those as well as the subjects to say, all right, these are less nice. They're renting for this. They're all market rate, not subsidized. These ones are a lot nicer. Here's what they rent for. And then we could take a look at, from our walkthroughs of the subject, say, how nice is our facility compared to the competitive landscape? If all we did is just have the ability to rent at market with the product we have today, how much could we raise the rents and fill the place in like 6 months or 12 months, depending on the duration of the leases, with our current quality level? And then what incremental improvements, renovation-wise, would we have to make to the common areas and the units themselves for the biggest bang for the buck in raising the rents a little further to be even more competitive? And then operationally, we've got the flexibility to decide we should be able to raise the rents by $300 a month. We're only going to do $250, and we can lease this place up in a hurry with no concessions. Or we could take a longer period of time, go for the whole $300 of rent increase, get the cash flow, but it's going to take us longer to lease the property up. And then we've got to run the sensitivity analysis to figure out which of those is the most appropriate. But really understanding the competitors and seeing their photos, walking the property to see what the reality is versus the photos, assessing the quality of your property and each of the individual features, and then making a really intelligent decision about the renovation plan and the contingencies to go with that. That's a gigantic part of the due diligence process. And to us, I think that's really the heart of what we do. That's the type of work I did for a couple decades as an active manager before getting into more of this passive role that we're doing right now. Understanding the property management. Are they responsive? Do they have a good web presence? Do they have a social media strategy that's coherent? Are the reviews from the current tenants satisfactory? If you don't have all that, then that's a huge value add. Just fixing that problem alone might raise your rents by 10%. And more importantly, reduce the tenant turnover and reduce the management and maintenance costs associated with all of that turnover. Just having competent management in and of itself is a huge value add to a property. So if you don't have a good management in place right now, you're going to buy it at a discount, but you have to have a good day one plan about, well, who are you going to use? And show me some turnaround situations where this property manager took an asset like this with a poor online reputation and no social media presence and a really crummy website and ineffective on-site leasing agents. How do they turn it around and what results do they get? So we can kind of extrapolate how will that apply to this particular building. So I'm always extremely interested in that. And then the reputation management, getting good online reviews is important. Another factor, and this is something you can do from a distance, it's more spreadsheet based, is this a growing market? So if you're creating jobs in a submarket, that usually is a great indication there's going to be more demand for real estate. And if there's more demand for real estate, that usually means that rents and prices are going up. So that's always something that we like. So most of the buildings in this Kansas City portfolio that we bought are in good submarkets. One of them is neutral, but the other three are okay. So that was something important to evaluate. So then the next thing is, what have things sold for recently of a similar quality? And it's easy for me to say that. It's really hard to do because each property is so unique. There's always something different about every single comp. So there's a lot of judgment. It's very much an art and a science. But we want to understand, are we getting a good value on this purchase or are we paying market? I feel like we paid a fair market price. I don't think we got a deal, but I think for the rents that we had in place, for the quality of the property, we paid a fair price to that family that had had it for 29 years. And since there was so much upside for us, that was great. We didn't need to get it at a steal because there was no distress involved in it, really. On the exit, we need to take a look at what have nicer properties that are market rate as opposed to LIHTC selling for to validate, do we think that this is a realistic exit price? And I want to try to build this model in a way that I'm not reliant on the real estate market in general experiencing 4% annual rent increases. I want to assume that the rent increases are going to be flat. If the vacancy rate now is 5% or 6%, I'm going to probably assume it's going to be the same, or maybe I'll even take it up to 7 just to stress test it a little bit. I really want to be reliant on the fact that given the quality of the property and with the renovations we've got in mind, we're going to, for example, say $300 a month of rent increase is warranted. If we just get $275 and nothing else works for us, can I still hit this exit price based on the comps I've got out in the market right now? If so, we've got a really solid case to hit our numbers with some headwinds. And if anything goes our way, we should be able to exceed the results that we expected. Contingencies. So an important thing to understand is some of the elements of your construction plan are going to have much more volatility than others. So you may find that you've got a complex that is older that does not have water efficient shower heads, faucets, and toilets, and that your water bill is very, very high, and that the local water utility will sponsor you and give you a lot of incentives and rebates to swap out those old fixtures for new ones, in and of itself a very desirable thing. And you can reduce your water and sewer usage and get some great reductions from your OPEX. As a general rule of thumb, operating expenses. So every dollar you can reduce your operating expenses, let's say on your water bill, translates in general to about a $16 increase in the value of the property. So it's a really huge lever for us. When looking at the degree of risk of implementing a water management strategy across the property, that's a relatively lower risk one. You're just changing out a toilet, you're changing out a shower head or a faucet. So the amount of contingency reserve I have to have for that phase of the renovation is relatively smaller. Something I'm a lot more worried about is I've got an ancient swimming pool with an aged plant that hasn't been touched in 29 years, and I think I've got to change out the sand filter and a couple pumps, but I'm not sure what other problems I'm going to have once I get in there and start working on stuff. I might find that some of the intake lines are clogged as well. This is a much higher degree of risk on the renovation budget, so I've got to have a much larger band of contingency associated with this sub-project. So what I don't want to see is 4% contingency as peanut butter spread across an entire project blindly without thinking through all the individual subcomponents of the master renovation plan and the risk factors that could go into each one of them. And this is just me being burned over a couple decades of doing renovation projects. Some things I can really forecast well, and some things, like, honestly, it's just a shot in the dark, and you've got to have contingency in place for things like that. Similarly, on your OPEX budget in future years, it's very nice to have some contingency in there just in case insurance rates go up by double the inflation rate, or maybe the property tax assessment, you really get hammered because the city's got, they're running a deficit this year, so they jack up their tax rates on property taxes. Do you have a contingency in your operating expenses to be able to absorb that? These are things I like to plan for. Financing, it's nice to not be overly leveraged. And if you can get a relatively attractive interest rate for today's market, how long can you lock it in? That's definitely another factor. I could talk about this for hours. It's actually one of my most favorite things when evaluating a project, is trying to think about all the things that can go wrong and what am I going to do to offset all these things. But it's definitely, you can't spend too little time on this. The other thing I'd really encourage you is that if you're investing out of state, get on a plane. It's only going to cost you $400. Fly out, see the property, go visit the competitors, talk to the property managers of each of the properties, and the information they will share with you will be astonishing, and your understanding of the risk factors will be so much deeper. You'll also learn a lot more about, I've heard an awful lot about this company is going to downsize their operations, there are going to be some job losses. Well, I'd like to know about that. That's probably not in the newspapers yet. They only know about it because 16 of their tenants work at that warehouse and they've been given notice. It hasn't hit the media yet. That's really important intelligence for you to have. On the contrary, you might have 5 tenants that are working at some factories who have some massive expansion project, but that's not in the media either. Going to be a lot of job creation in this market. Going to be a lot more demand for rental properties. That's a plus you want to know about as well. Anyway, I can just go on and on and on about that. That's probably enough. How do you hold title? So this is something that if you've got a financial planner or if you've got an attorney working on your overall estate plan, you may have set up some trusts to better manage the estate process. So some or all of your assets will pass to your heirs or your designated charities in a very streamlined process after you pass. So how you hold title in the investment is important. The important thing for us to know is that we offer you the flexibility. You can change. You might initially invest as Lon Welsh, and then you might need to change it to the Lon and Teresa Trust or whatever. We can easily do that for you. Not everybody can. So if you have made some progress on your estate plan, but you haven't dialed it in, ask to find out, can I change it? Because that might be flexibility that matters to you. Just a small point, but for some of you, it's going to be an important one. And the last factor of due diligence is how are you going to fund it? You could use cash, self-directed IRA. You could take money out with a line of credit on your property you're about to sell. If you are in the mountain region and you need to get a second mortgage, take cash out from a rental property that's got a lot of equity in it, I can put you in touch with banks that'll do that. But have some thoughts about this. There might be different tax pros and cons for each of these different choices. So be sure you consult with your financial advisor about what's the best way to fund different types of investments. We talked a little bit about depreciation and liquidity, so we covered all that. So there's really a couple different ways you can go about investing. The one that people usually start with is as an active investor. So you pick a 4-unit as a rental and you look at all the properties on the market, pick one out with your realtor, sign the loan, maybe you do some construction on it to renovate it a bit. You find a property manager or you've leased it out yourself by interviewing all the tenants and you maintain it and do the books and file the taxes and then refinance it and eventually you have to sell it. It's just a lot of work. In some phases of the economic cycle, you'll make a lot more money by doing this and it's worth it. So you get paid for your time. At the current phase of the economic cycle, at least what I find in Denver is that most active investors are making less than we do. Because we're investing in places other than Denver that are more profitable. The general partners do all these things on this list on behalf of our limited partners. As an investor with us as an LP, all you have to figure out is, do I want the medium-term fund or do I want the long-term growth fund? How much money do I want to put in each one? And if you want to read our quarterly reports, I hope you will. I think they're really interesting. You can focus on other stuff like your family, as opposed to, it's a full-time job for 3 of us just to go pick out all these things and keep track of them once you've made the investment. So a couple of testimonials. Jared is an active investor who had at one point, I believe, 9 or 10 different rental properties, a couple tenants that were really a headache. He's sold off several of them, invested with us, and he's really glad to have his time back with these passive investments. Jay, very similar. Looks like we're on track to have good returns, probably better than I was going to have with my rentals, and I don't have the headaches anymore. And then Justin was able to sell all of his rentals. He's actually moved to Portugal part-time now and really living the dream. And the passive income has really enabled the lifestyle that he's always sort of dreamed about. So I'm really glad that we've been able to help these guys out. So imagine and picture this. You finally get to have your time back and you have time to relax and enjoy time with the people who matter while your portfolio continues to grow. And I want that for you. So let me ask, did we provide that value for you today? Did you get some insights that you'll be able to use to make better investment decisions? Here's the funds that we've got. We talked about all these today. Not every investor is the same, so everyone's going to need a slightly different mix of investments, and you can talk with us and we'll try to help you sort that out. So the benefit really is that we get you good results. You have more free time. You'll probably have a lot more diversification in the real estate part of your portfolio than you have today, and it'll be completely passive. So you need to be an accredited investor to invest with us. So if you meet one of these criteria, you're good to go. If you're a single household with income over 200,000, or if you're a dual income household over 300, or if you have investable assets over $1 million, not counting your primary, any of those makes you accredited. A lot of ways to fund the investment. Not only do the general partners invest alongside you, we also give a lot of our profits to different charities. So we love to give back to our communities. So if this sounds interesting, set up a one-on-one time for us to talk. At the very beginning of this, we talked about an investor with a rental condo who was looking at selling it, and we looked at the 4 different alternatives: keep it, or sell it and put it in the stock market, medium term or long term. I'd love to do that analysis for you. So you can go to irontoncapital.com/IC, like Ironton Capital Analysis, and set up a time, and we'll be happy to help you out. Thank you so much for your time today, and I hope we get to invest with you soon.